Hey there, future Wall Street titans, ready to dive into the world of finance and investing? Ever feel like the stock market is a rigged casino? You're not alone. Many investors have felt the same way, especially when the market takes them on a roller coaster ride. Burton Malkiel's A Random Walk Down Wall Street rocked the investing world, turning traditional wisdom on its head. This book challenged the status quo and made waves in the financial community. This book is your roadmap to navigating the market maze, and trust me, it's a game changer. It simplifies complex concepts and makes them accessible to everyone. Malkiel's masterpiece, first published in 1973, debunked popular myths with academic rigor and a touch of humor. It was a breath of fresh air in a world filled with jargon and complexity. He argued that stock prices are mostly unpredictable, especially in the short term. This was a revolutionary idea that changed how people viewed investing. Forget those hot tips and guaranteed strategies. Malkiel says it's like trying to outsmart a drunkard on a stroll. The market's randomness makes it nearly impossible to predict short-term movements. Instead of chasing illusions, Malkiel champions a simpler, more effective approach: index investing. This method focuses on long-term growth and stability. This revolutionary idea suggests that buying the entire market through low-cost index funds is a winning strategy. It democratizes investing, making it accessible to everyone. Why try to beat the market when you can join it? This approach reduces stress and increases your chances of success. This book isn't just about theory, it's a practical guide that you can apply to your own investing journey. It's packed with actionable advice, real-world examples, and a healthy dose of common sense. You'll find tips that you can implement right away. So buckle up. Get ready to embark on an exciting journey through the world of investing. As we break down the key takeaways of this investing Bible, we'll explore its core principles and how they can transform your financial future, and equip you with the knowledge to build your own financial empire. With the right tools and mindset, you can achieve financial independence and success. Let's talk about the efficient market hypothesis, or EMH. Sounds intimidating, right? Don't worry, it's pretty straightforward. The EMH is a financial theory that suggests that stock prices fully reflect all available information at any given time. Imagine the stock market as a giant information processing machine, constantly absorbing and analyzing data. Every bit of news, every rumor, every earnings report, it's all constantly being analyzed and reflected in stock prices. This means that the market is always up to date with the latest information. The EMH states that all available information is already factored into the market price of a stock. So, the current price is the best estimate of a stock's true value. This means that trying to consistently outsmart the market by picking individual stocks is a fool's errand. The market's efficiency makes it nearly impossible to gain an advantage through analysis or insider information. Think of it like a game of poker where everyone has access to the same information. Good luck consistently outsmarting your opponents in the long run. The odds are stacked against you. Now, before you throw in the towel, remember that EMH doesn't mean you can't make money in the stock market. It simply suggests that making consistent, above-average returns is very challenging. It just means that finding undervalued stocks or predicting short-term movements is extremely difficult. The market's efficiency levels the playing field for all investors. The market is incredibly efficient at incorporating new information, making it tough to consistently gain an edge. However, understanding this can help you make more informed investment decisions. Remember that stroll we mentioned earlier? Well, that's the random walk theory in a nutshell. This theory, closely tied to the EMH, suggests that stock prices move randomly and unpredictably, much like a drunkard wandering aimlessly. Past performance, chart patterns, technical analysis, none of these can reliably predict future price movements. It's like trying to predict the next step of that intoxicated individual. Impossible. But don't despair. This randomness doesn't mean investing is a gamble. It simply highlights the importance of a long-term strategy and a diversified portfolio. By embracing the unpredictable nature of the market, you can position yourself for success without relying on flawed predictions. Now for the million-dollar question, if stock picking is so tough, how do we invest wisely? Enter index investing, the hero of our story. Instead of trying to pick individual winners, index funds allow you to buy a tiny piece of the entire market.
Think of it like owning a slice of every company in the S&P 500. As the market grows, so does your investment. It's like hitching your wagon to a rocket ship powered by the collective growth of hundreds of companies.
Index funds offer several advantages. They're inherently diversified, spreading your risk across numerous stocks. They're incredibly low cost, with minimal fees eating into your returns.
And best of all, they consistently outperform actively managed funds over the long term. Section 5, the Balancing Act. Understanding risk and return. Let's talk risk and return, the dynamic duo of the investing world. They go hand in hand like peanut butter and jelly, or Batman and Robin. Simply put, the higher the potential return, the higher the risk involved. Imagine investing in a startup company. It could skyrocket in value, making you a fortune, or it could crash and burn, leaving you with nothing. That's high risk, high reward. On the other hand, investing in a well-established, stable company offers lower potential returns, but also lower risk. The key is finding the right balance for your risk tolerance and investment goals. Are you a thrill seeker who loves a good roller coaster ride, or do you prefer a calm and steady Ferris wheel experience?
Section 6. The Snowball Effect. Witnessing the power of compounding. This section will open your eyes to the incredible potential of compounding, a concept that can transform your financial future. Get ready to be amazed by the magic of compounding. It's a financial phenomenon that can turn modest investments into substantial wealth over time. It's like a snowball rolling downhill, gaining size and momentum as it goes. The longer it rolls, the bigger it gets, just like your investments. In investing, compounding means earning returns on your initial investment and on your accumulated earnings. This creates a cycle of growth that accelerates over time. Let's say you invest $1,000 and earn a 10% return. This is just the beginning of your compounding journey. You now have $1,100. That extra $100 is your first taste of compounded earnings. The next year, you earn another 10%, but this time it's on $1,100, not your original $1,000. This is where the magic starts to happen. See how that snowball is starting to roll? Each year, your investment grows more, and the returns on those returns keep increasing. The longer you stay invested, the more powerful compounding becomes. Time is your greatest ally in this process. It's like planting a tree. The best time to plant it was 20 years ago, but the second best time is today. The sooner you start, the more time your investments have to grow. Start early, be patient, and watch your wealth grow exponentially. With patience and consistency, you can harness the power of compounding to secure a prosperous financial future.
Section 7. Outsmarting ourselves, behavioral finance and investing psychology. Here's a secret. Investing isn't just about numbers and charts. It's about psychology, emotions, and our often irrational behavior. Behavioral finance explores how psychological biases can influence our investment decisions, sometimes leading us astray. We tend to be overconfident in our abilities, chasing hot stocks and ignoring warning signs. We're susceptible to herd mentality, following the crowd even when it goes against our better judgment. And we're plagued by loss aversion, feeling the pain of a loss more strongly than the joy of an equivalent gain. By understanding these biases, we can make more rational decisions and avoid common pitfalls. Remember, investing is a marathon, not a sprint. Don't let emotions cloud your judgment or derail your long-term goals.
Section 8, a winning game plan. Practical advice for new investors. Ready to put this knowledge into action? Here's your cheat sheet for investing success.
1. Embrace index funds. Diversify across different asset classes and keep those fees low. 2. Diversify. Don't put all your eggs in one basket. Spread your investments across different asset classes, sectors, and geographies. 3. Start early. Stay invested. Time is your greatest ally. The earlier you start, the more time your investments have to compound. 4. Tune out the noise. Ignore the hype and focus on your long-term goals. And 5. Seek professional advice. If you're feeling lost, don't hesitate to consult a financial advisor.
Section 9. Your journey to financial freedom starts now. Investing can feel overwhelming, especially for beginners. But remember, you don't need to be a financial wizard to succeed. By understanding the key takeaways from a random walk down Wall Street, you're already ahead of the game.
Start by educating yourself, setting clear goals, and developing a solid investment plan. Remember, this is a marathon, not a sprint. Stay disciplined, be patient, and don't be afraid to seek help when needed.
Section 10. The future of investing. The world of finance is constantly evolving, with new technologies and investment opportunities emerging all the time. But the fundamental principles outlined in A Random Walk Down Wall Street remain timeless.
As you continue your investment journey, stay curious, adapt to change, and never stop learning. The future of finance is bright, and with the right knowledge and approach, you can achieve your financial dreams.
Section 11. Conclusion. Embracing the Random Walk. A Random Walk Down Wall Street is more than just a book, it's a philosophy. It's about acknowledging the unpredictable nature of the market and embracing a disciplined, long-term approach to investing. So take a deep breath, ignore the noise, and start your own random walk down Wall Street. You might be surprised at where it leads you.